Your blog is awesome for all types of insights, discretionary traders or quants, on just understanding markets and different dynamics. And you publish lots of different ideas there. So I want to touch on two of them. And one of them, the first one, is actually pretty darn timely because we're recording this September 20th. And I think we just got our 5% pullback
What, did
in
we
the
get it
market.
today?
I think so. I think we
Oh
did.
crap! I just tweeted that we hadn't had one today, year to date, this morning.
I think we got there. If I look,
Oh crap! I need to check. Oh man, that was a perfectly timed tweet.
oh man, yeah, it is. It is perfectly timed because I think we got it, if not pretty darn close. But you
I'll have to take a look
basically
afterwards.
you put out this research piece, or you set out to ask the question, how often does a 5% pullback in the market turn into a 10% pullback, and then even going to a quote unquote bear market 20% pullback? How often do those events occur? And so I'd love for you to maybe just kind of talk through this research piece and kind of what you found when you did it.
Right. This research piece came from a discussion my trading buddy and I were having. Is more of how often do markets sell off? How people always worry at a 5% sell off or a 10% sell off. And it's like how often can we expect that? So I was curious. It's like, okay, starting from the beginning of the year and going and just going through, how often do we get a 5% sell off in the beginning of the year? And that's where this research piece came about. It's just understanding, are these often occurrences, or 10%? More importantly, it's like, okay, does 10% happen that often? I was actually kind of surprised that the 5% sell-offs didn't happen as often as I would expect. They only happen on average 1.6 times a year. So, every year you basically can expect one. I was expecting that number to be maybe 2 or 3 times a year would happen. So that was quite surprising to me. And I did the data back to, I think, 1920 something. I forgot, 1929 is what I did the research back to. So I was really quite surprised that it just does not happen. Happening more than 3 or more times is not a frequent event.
Yeah.
So that first of all caught me surprising, is how strong bull markets we tend to be most of the time. And then I just thought, well, 5% happens that. Not that much. How often does 10% happen? And that was also like almost only every other year can you expect a 10% or more drawdown from the beginning of the year. Again, quite surprising. But it also tells you, okay, when these happen, it's not something to worry about too bad. The next step of research I did was saying, well, once we've gotten this far, once we hit the 10% drawdown, how likely are we to get to a 20% drawdown? And again, and I have to look back at my post to get the exact number on that one, 10%. Yeah, so only a little under half the time does a 10% drawdown become a 20% drawdown from the beginning of the year. So again, not very frequent. So every other year we have a 10% drawdown, and only half of the time does that go all the way up to at least a 20% drawdown. So a lot of this was trying to understand how often does this happen? How often should we start to worry in the markets, when that happens?
So I like this piece because this is, like you said, I mean, this is something now that can give us some stats behind these occurrences. So again, for today's example, if, S&P down 5%, well, we should expect that almost twice a year. Like that's par for the course. That's what we get if we want to invest in equities. We have to expect some of that volatility. But I guess the larger kind of question, or if I'm sort of reading in between the lines here, I mean, these types of research pieces that you do, I mean, this ultimately could lead into a trade thesis or strategy itself, right? I mean, if you had enough convincing data here, if we said, wow, 95% of the time when there's a 5% drawdown, it goes to 10%, that could in fact turn into something. Is that how you kind of view these types of pieces?
This type of research wasn't in a sense to be generating a strategy, but more to deal with the emotional side of trading.
Gotcha.
Okay, when this happens, should I be prepared to go on? Is this something I need to worry about? Even though I am fully systematic, I still have to deal with the emotions of, I want to stop trading because the markets look bad. And I've gotten pretty good about ignoring that overall, but I know there's a lot of people that are still like, should I be worried? Should I not be worried? And this kind of says, look, 5%, it happens every year. Don't panic yet. Or
Gotcha.
here's the expectations to set up.
Gotcha.
We've reached 10%. Just because we've gone down 10% doesn't mean we're going down 20% kind of thing. It's more of trying to
Gotcha.
set up expectations for understanding. Okay, this is possible now that this happened. There's 50% chance it continues down. 50% chance it doesn't. But again, so it's a lot of it is just trying to set up context of whether one should be worried or not worried and things like that. It's not that research was not necessarily meant as okay, let me see if I can make a strategy out of this. Mostly because it just doesn't happen enough. Doesn't happen enough to kind of say, okay, at 5%, that's only once or twice a year kind of thing. So it's not
Right.
enough in my book to say, okay, yeah, let me see if I can make a full strategy around this.
Gotcha. Yep. Sample size and number of occurrences, probably something we'll talk about a little bit later. So thanks for that explanation. That makes sense. Hey, it's Evan here. I hope you enjoyed this clip from our full-length interview. Don't forget, if you want to hear this entire episode with even more insights from our awesome guest, you can find it by searching the Smarter Trading Podcast in iTunes or on your favorite podcast app. You can also find all of the show notes for this episode by heading to thetraderisk.com/podcast. Thanks for tuning in.